I thought it was Tim. It was Jim. I apologize. Jim said, you mentioned that you can search for positions. Can you search for poor man's covered call or calendar spreads with a specific delta ratio and implied volatility ratio? Yes. So in any strategy, in most strategies, we're going to take a look at the calendar call right now. When we go into the search tool, you'll see a list of positions that match our default criteria. So one of our default here is calendar leaps number 1. It's just a starting point. We've put in criteria that we would use as a starting point if Ernie and I were opening our own diagonal spreads today. But, of course, the whole power of the search tool is designed that you can customize it any way you want to. Oh, and then Jim, you also said, what about weeklies as well? Yes, weekly options you can screen for as well. So, in any search, you'll see the same structure below the results. Options, technicals, fundamentals, and lists. So stock technicals and fundamentals, and the options as well. So you see here we have a wide variety of data for the options that we can screen in the calendar spread. The time frame for the short, and the time frame for the long. Okay? You wanted to do weeklies, I might look for something that, say, 2 to 14 days out in time on the short, and maybe I'm only going 3 to 4 or 5 months out. Well, let's go 2.5 to 3. Let's go 75 to 105. Okay. Glenn commented back, says, hi, will this be recorded? Yes, Glenn. I did mention that before. Maybe it was just stuck in the loop there, but yes, this presentation is recorded, would be made available, and we send an email out to all of you when the archive has been posted. Okay, so you can adjust your time frame. Down here, you see the criteria. I can set the hard value, Jim, for implied volatility of the short, implied volatility of the long, or the implied volatility range of each option. Where are they now compared to where they have been over the life of the option? And then, of course, the implied volatility ratio. Well, what is this, and why would it be important in this strategy? The IV ratio is the implied volatility of the option that you're selling near term divided by the implied volatility of the long. In this case, what we would generally look for, just as a basic theoretical principle, is that I'd want the implied volatility of the option that's shorter term that I'm selling to be higher than the option that I'm buying, to get a more favorable time decay on the short as opposed to the time decay I might lose on the long over those first 7 to 14 days. So I might just use an implied volatility ratio of greater than 1. Anyone where the sell implied volatility is greater than the buy implied volatility. Now I can set the minimum for the net debit, price I'm willing to pay, minimum max return, range out of the money for the short. Let's keep that, let's go 2 to 5 on this one, okay? Because we're going shorter term weekly, so I want to be a little bit out of the money, but I don't want to go too far out of the money, so I still want a reasonable premium. And the far term call, maybe I want to be about the same. I want to be about 3% in the money to 6% or so. All right, now, you'd mentioned the delta ratio. We talked about IV ratio already. For the calendar spreads, the delta ratio. This one's reversed. It's the delta of the buy divided by the delta of the short. Typically in a diagonal spread, I'd want to see a delta ratio or delta on my long maybe of 0.6 or greater. Okay, so that goes into that 3 to 6% range. Of course, a delta of 0.8 might be 7, 8, or 10% in the money. So I may need to increase that for the in the money on the far call. What I'm looking at here is a delta ratio of 1.8. So that means that the delta of my long should be about 80% higher than the delta of the short. So as the stock moves up 1 point, I want to be gaining more on the long than I'm losing on the short, which I may have to buy back. Okay, so I'm gaining on the long, but I'm losing on the negative technically as it's increasing in price. So we put in a base delta ratio here of 1.8, okay, or more. And I'm going to change this debit to strike difference ratio to less than 1. I'll explain that in a moment. Then what you can do, of course, is once you've got that all set, you can go into the technicals, and mid to large cap stocks are good volume stocks. This is measured in thousands. You could screen by just the stock volatility. I might want to see stocks that are currently in an uptrend, and these are all the same filters. This field for stock technicals and stock fundamentals is the same in every strategy. You have the same criteria in every strategy. What changes typically is just the options criteria, because there's different things I want to look for when I'm buying a call or buying a put as opposed to doing a spread of 2 legs or a spread of 4 legs like the iron condor or the butterfly Frank mentioned a little while ago. So I'm a neutral bullish calendar call spread. I'm going to look for stocks that are trading above their 20-day moving average. Maybe I'll use a positive MACD cross signal as well. I could just look for some basics, earnings per share growth, a good relative PE ratio, stock prices, $10 or more. If you wanted to look just for stocks that were $50 to $100, you plug that in as well. All right, now let's see if we've got any results. So go ahead and submit that search. Wow. I narrowed the entire universe of diagonal calendar spreads with weekly and going about 90 days out in time to 2 results that match the criteria that we wanted. Dollar General, stocks at 178.98, buy the August 170, sell the 29th of May 185 for 295. I didn't avoid earnings between now and expiration, but that's something I might typically do in these situations as well. Marvel Tech Group comes up as well, stock at 30.15 roughly, 30.13, selling the May 31.50 strike for 52 cents, buying the August 28 for about 3.90. Okay, so now let's take a look at one of these. I entered in this extra ratio filter you didn't ask about. Of course, you can see here you can also limit the bid-ask spread on the short or the long option in most strategies, so you're not looking at things that have a very wide bid-ask spread, like we saw at the beginning for Lance with those weird, some of those weird bid-ask spreads on the ZNGA position, looking out for the married put spread. But this debit to strike difference ratio, this is the net debit that you're paying to enter the diagonal spread divided by the difference in strike prices. And I always want this to be less than 1. Jim, let's talk about why. We're going to use the Dollar General one, so I'm not messing around with these 50-cent strike differences. But let's just take a look at the profit and loss of the Dollar General position. I might want to be a little bit closer. The 180 might be closer to the position, but that didn't come up in my criteria. The 185 did. All right, so my net debit is what? $13.22. I'm going to pay $1,322 per contract to enter this diagonal spread. My strike difference is 15. Okay, so I've got a $15 strike difference between our 170 bought call and our 185 short. Why is this important? Well, some people refer to this strategy as the poor man's covered call. That makes me nervous for 2 reasons, and I've talked about this before, but we're here today, so we'll talk about it again. A covered call position that people usually learn first when you first apply to trade options, you may just get approval for level 1 trading, which might allow you to do covered call positions and maybe buy puts. And then level 2, they might allow you to do other things, buy calls, buy puts, depending on what you get on level 1. Okay? But the covered call is a static structure. I buy Dollar General at 178.98 and I sell the 180 call, and if the stock goes up to 100, goes up to 200, goes up to 300, I make that 4%, 3% return if assigned if I don't roll the position. So we get a 3% premium here on that position. If the stock falls 10%, well, I'm only looking at a 7% loss, but it's capital intensive, right? 100 shares would have cost me $17,898 to get into. Here, it's $1,300. Okay, so this is called the poor man's covered call because instead of buying the call and selling the at or out of the money call you would, you're paying a fraction of the price to buy a call option, which moves up. It doesn't simulate stock ownership per se, but it moves up as the stock moves. But if you set up the structure wrong, if my net debit was greater than the difference in strike prices, we'd have a lower return, but we'd also see this slope here come down faster and possibly enter into a loss zone if the stock goes too high. because the debit was greater than the difference in the strike prices. Why I always use that other is because if the stock suddenly jumps, if Dollar General suddenly jumped up to 190 for some good expected news, let's say on Monday, and I get assigned early, because my call is now in the money, I get assigned early on Monday or Tuesday instead of on Friday. Hey, well, I'm making the maximum profit. Remember, in a covered call, it can go anywhere and you're still making the 3%. Here, you're giving some back because this delta is getting to 1 faster than the delta here. That's why it slopes off. This is still going up to 0.7, 0.72, 0.73. After 2 to 3 days, with only a few days to go, this delta of your short call is going to 1 or 0 very rapidly. And if it's in the money, it's going to 1 faster. So every dollar the stock moves up, you're losing more on the short now as you get closer to expiration than you're gaining here. If I'm assigned early, even at 190, and I thought, hey, I'm going to have a $600 return, well, it would have been less, but if I'm going to get assigned early, what does my broker have to do? They have to exercise the long to deliver the short obligation. They're going to buy shares of stock for me at 170 to cover the obligation of being assigned on stock I don't own at 185. I'll get $15 back. If my debit was $16, I'm at a loss on the position. Even though it went in the direction I wanted to, I'm at a loss because the net debit was greater than my difference in strike prices in that scenario. The other, so it's not that, oh, if it goes up and it just keeps going up, I'm always going to have a profit. If you structure it wrong, you could be at a loss. And even if you didn't structure it wrong, you'd still be at less than the maximum profit. So it doesn't behave the same way as a covered call to the upside. What about the downside? That's worse. Talking about I mentioned a 10% decline. Let's call it $18. So if this stock falls to 160, and I had a covered call position where I generated 3% premium and the stock fell 10%, I'm down 7% on my investment. Here I'm only investing a fraction of it, $1,322. But if the stock falls 10%, the leverage works both ways. If this drops down to 160, on or near our short expiration date, we'll just put it on the expiration date, where we paid $16.40 for this long and our debit was $13.22. The expected price of our August 170 call with a 10% decline in the stock is $627. You lost, basically you're at 50%, aren't you? Our total debit was $13.22 to get into the position. The stock falls, sure, our short call expires worthless. We've got a debit of $13.22, but we're at less than 50% value on our position with a 10% decrease in the stock price. So that's why I don't like the term poor man's covered call, because yes, you're using leverage to do it, but it doesn't behave the same way as a covered call. Now, a comment comes in, I think it was from Graham. Graham says, yes, but if you structured the calendar spread with a deeper in-the-money call with a higher delta, you wouldn't see as rapid a decline. And you're right. But remember, based on what I look for with the delta ratio I wanted, the range out of the money, this is closer. This is probably only a delta of 0.65 or 0.7, maybe, Graham. Let's just take a look at the research tool. So I could structure it differently to protect against that. If there's a 10% drop, maybe I'm not losing 50% on this long option. Yeah, delta of 0.65, okay? So if I was at a delta of 0.8, maybe the loss wouldn't have occurred. But none of the deltas of 0.8 came up in my search results. Whether because the net debit was greater than the difference in strike prices, which I was filtering out for, or whether because the in-the-money options didn't give me the implied volatility ratio I wanted of greater than 1. Whatever reason, they were filtered out, and we only saw those two positions, the Dollar General position and the other one that we were looking at as well. Okay, so to answer your question, Jim, with a little bit more insight into the diagonal spread, yes, you can set your expirations to your desire in the calendar spread. This does diagonals, and this search does horizontals. We can search for same strike spreads, or the ones we were showing where you're buying in the money or lower strike call and selling a higher strike call. Set your time frames. Set your IV ratio. or even use the percent implied volatility range. Range out of the money, simple measures, and of course the delta ratio that you mentioned, and then we discussed why we use the debit to strike difference ratio and why, of course, I don't like using the term poor man's covered call for this strategy because it behaves differently. And then Graham pointed out that, well, it behaves more like a covered call if you go deeper. Let's take a look at a deeper one that still matches our criteria. I'm going to increase the delta to 0.8 or more there. And let me just take out the range out of in the money, excuse me, because that delta is going to take care of it. And yes, I still want to stay maybe at 1.8. Maybe we'll go higher. Maybe we'll go 2. But I'm going to keep the debit to strike difference ratio and the applied volatility ratio as well. Same time frame to expiration, same type of stocks. Okay, so several marvels came up with the deeper in the money and that matched the criteria we wanted for the debit to strike difference ratio. We're going to take an even one. We're going to take this one here, going to the 25 strike with a 31. Okay, well, oh yes, and I can customize the columns too. If I wanted to just put in the delta ratio here, I already have implied volatility ratio here for this position, but I could add in the straight delta for both options, the delta ratio, and more. And okay, William says, that's why. This is another reason. Thank you, William. William says Marvel has earnings next week, and that's why the skew is working in our favor in this case, and why we're seeing multiple positions, because these are highly inflated against the long options, which are probably slightly inflated, but I wouldn't do this strategy, a bull put credit spread, bear call credit spread, or anything like that going into earnings because of the potential surprise. But let's take a look. Let's take a look at that profit and loss chart again. Okay, so here's a structure with a deeper in the money. And if the stock fell to $27, that'd be our 10% decline, right? So if the stock fell to $27, in this case, towards our expiration date, both have pretty high volatility at this point. And that's something we'll talk about in a moment too. But look, our debit to get in was 518. The expected value, if that falls 10%, is 351. Okay, so we're losing $239 from what we paid on that call. It's not quite half. It's probably about 43, 44% of the value. Yeah, maybe about 40%, excuse me. But 10% decline in the stock with earnings coming up, you might be down 40% on your position. But interestingly enough, one thing that we have to take into account is this volatility, this being used to price the expected value of our long option near the short term or on the short term expiration with earnings coming out next week. Once the earnings come out, this could drop. This volatility could change, so we could be looking at a much lower expected price. How would I check that? All right, I'm going to scroll back up, and next to our long August 25, quickly got a link to that research tool. I'm going to go stock research and option research. When you're doing diagonals, and sometimes when you're doing the married put positions, when you're doing any analysis that's using different time frames and you're using that calculate feature, you want to make sure that if you have an event coming up, you check this IV range. Okay, so right now it's at 10%. This isn't too bad. It's at 10% of its total implied volatility range since the option, this specific exact option, was released on the market. It's gone from 0.3476 to 1.6100. That was probably right around the bottom there sometime in March is when that probably hit 1.61. But we're at 0.47, so we're in the 10 percentile. We're not too far away. We are a little bit far away. But let's assume that the volatility doesn't go back to the low after the earnings report next week, but it goes halfway down. All right, so we're looking at a difference here of 0.13. Let's say it goes to 0.40. That we lose volatility after the earnings event. It doesn't go all the way down to 0.35. It just drops down to 0.40. So let's go back to the custom spread tool. And let's put in a volatility of 0.40. Is it going to have much effect? Well, at 0.48, 0.479, we'd expect it to be 351. Okay, so we lose about 40 cents. With a volatility of 0.40, it drops down to 315. 40 cents doesn't seem like much, but it's significant, isn't it? When we're talking percentages of a debit of 518. Okay, so the total debit was 518. 40 cents of that is sort of significant. So we'd be down about, expect to be down about $203, or about, again, not quite half, probably around 40% with that 10% decline and the effect of volatility as well. All right, so for Graham, the structure, the deeper in the money, not hurt as much. In this case, we have a higher delta in this case as well. I'm sorry, let's go back. I didn't check the delta. Yeah, 0.810. So that's the higher delta structure you were talking about, Graham. Didn't take that 50 or 52% loss, but it's still around a 40% loss with a deeper in the money delta, deeper in the money structure on the Marvel position, and an expectation, of course, with a shift in volatility, because this was around earnings. And this is not, I said it before, I'm not saying do calendar spreads around earnings. I specifically avoid that in that case. I might look at a long strangle or a long straddle depending on the cost and the increased implied volatility if it looks worthwhile to enter. But anything with sort of a capped gain and a chance for a significant leverage loss is dangerous to play on earnings. Just avoid the unknown. Don't play the unknown unless you're in a single-digit risk protected position or you're doing proper position sizing where the monetary risk of this isn't more than 1 or 2% of your total portfolio value. Okay, so Jim, that sort of covers the topic there for searching and screening for the calendar call spreads. And Graham, that takes care of the comparison that we were talking about with using a deeper in the money position.